We're also on IPO watch, specifically with Chinese ride-hailing company DIdi. Let's bring in Yahoo Finance anchor Akiko Fujita, who's following this IPO for us. Akiko, the pricing looks to have been pretty strong.
Yeah, no question about that. This is by far the largest U.S. listing of a Chinese company since Alibaba went public back in 2014. We should also mention it's also been one of the fastest processes in terms of listing. The company priced its shares just 3 days after it launched its roadshow. Now those shares priced at $14 a piece will begin trading on the New York Stock Exchange, giving the company a valuation of roughly over $60 billion here, which is pretty much in line with the valuation they commanded in the last private funding round back in 2018. Now, a lot of people know DIdi as the company that essentially bought out Uber's China business back in 2016, but it really has come to dominate the Chinese ride-sharing market. They've got about 90% of the market share right now, with nearly 500 million annual active users, more than 40 million daily average daily transactions on the platform. Outside of China, they do operate in about 15 countries, but more than 90% of the revenue for the company comes from its home market. And that lack of diversification could create some headwinds for DIdi. We saw it last year when Chinese economy essentially shut down during the pandemic. The value of the transactions on DIdi's platform dropped by 1/3 at the time. While the company did post a profit in the first 3 months of the year, they did post a net loss last year of $1.6 billion. Now, on the regulatory front, this is something that I think a lot of investors are going to be looking for, because they are facing pressure both from the U.S. as well as China. Earlier this year, DIdi was fined by Chinese regulators for what was deemed to be anti-monopolistic practices or alleged monopolistic practices. In May, we had DIdi executives summoned by the Transport Ministry over the pay of their drivers. And then, of course, here in the U.S., there is this threat of delisting of all Chinese companies, essentially because of this act that was passed last year that says Chinese companies have to undergo the same types of audits that American companies do. And DIdi has laid this out as a risk factor in their filing, saying that the threat of being delisted may materially and adversely affect the value of the investment. Now, we should point out finally, guys, some big name investors behind this. No surprise, SoftBank, the biggest shareholder here with 21%. Uber, as a result of that 2016 transaction, has a 12.8% stake in the company, while Tencent has a roughly 7% stake. So a lot of those guys expecting to get a big windfall if this is in fact a successful IPO.
Kiko, why am I not surprised SoftBank is involved here? They have their hands in everything.
Well, they do. And it's been interesting to watch, especially in the ride sharing space, because they have their hands in so many of these companies. Obviously, Uber, DIdi, Grab over in Southeast Asia. It almost feels like they've been sort of pulling the strings behind the scenes here about who comes to dominate that market. But DIdi's been the big winner by far in the Chinese market. And now they're going to have to convince investors here that, in fact, there is a lot of potential for growth in the market at a time when there's questions about saturation, especially in the big cities where DIdi's concentrated.
Well, I know you will be tracking that one all day. Yahoo Finance's Akiko Fujita. We'll talk to you soon.